I'm grateful for the opportunity to introduce my friend Dan Shea. He's with our BDO Capital Markets Group. Dan has been super successful in our market here in Salt Lake. It's a focus area for him for different businesses here, mergers and acquisitions. We called him up from the bullpen. He's our pinch hitter. Found out on Thursday that we had a switch up in our presentation here. So I'm grateful for Dan. He was one of our keynote presenters last year at the conference, and afterwards it was Dan's slide deck that was one of the most requested. Can we get our hands on that? Just the information that he presented was of great value to many of you, and we're grateful for each of you to be here with us. So I'll turn it over to Dan, and we'll have him run with it. Thank you.
Thank you, Brian. Brian called me, actually he didn't even call me, he emailed me on Thursday and asked me if I could come up. So unlike last year with the slide deck, this is all made up since Thursday. So it's just kind of what I feel is going on, and it has really no bearing in fact or what have you. That's a bit of a joke. Actually, we maintain this data all the time, and what's interesting about where we are in the marketplace really informs our clients. And our clients tend to be people who are contemplating selling their businesses, people and companies. We work with middle market companies with revenues on the low end of 20 million up to about 200 million. Of course, there's outliers on either end. We work all over the world, which is really kind of cool. I was in a session with Tommy Jensen just earlier, and Tommy mentioned that we have 1,500 offices. This is not meant to be a commercial for BDO, but just simply to say that with 1,500 offices and 70,000 people, and the middle market is our focus, the middle market really turns on transactions. By a show of hands, how many people in this room have been involved in some kind of M&A activity in their careers? So we have people who have experience. Almost everybody raised their hands. People who, I would tell you, if you've been deeply involved in one transaction, you're a bit of an expert. You've seen a lot. You've been through a lot of decision making from soup to nuts, and you have an opinion on things. So please share that. The things that I would really like to cover today have to do with the economy. We all talk about the economy. I'm sure in your role as CFOs and supporters of CFOs that you think about the economy. I certainly do every day, and I can tell you that my clients do. We constantly talk about the economy. The interesting thing about the economy, though, is it seems to inform short-term strategy. We all kind of know that if a recession comes, we're trying to predict when it is. We generally expect the recession to be relatively shallow as compared to the recession we went through 10 years ago, and usually that's been a good bet. So long-term strategy stays in place. Short-term tactical maneuvers are impacted by the economy, and that is something that I think will inform the other two sections of this presentation that I'd like to cover, which is the formation of capital. Where are we in the economic cycle, and how is that influencing the formation of capital, and how is capital influencing the economy and a business's ability to grow and transact? Lastly, I want to just talk some statistics about what's going on in M&A right now. Deal volumes, valuations. I'm sure you think about the value of your business all the time. We have lots of people who come to us. In fact, in BDO, one of the most common questions I get from the field is, hey, Dan, take a look at this data, take a look at this industry, and tell me what you think this company's worth. It's on everybody's mind. So let's talk a little bit about that. So speaking of the economic landscape, one more series of questions for a show of hands. How many people in the room think that there will be a recession within the next 12 months? A couple people. How many people think there's going to be a recession between 12 and 24 months? A couple more people. And then lastly, how many people think that the recession will occur greater than 24 months from now? recognizing that there will be a recession at some point. History would prove that out. I can tell you, though, that a lot of smart people who follow the economy say that recessions and upcycles don't end because of old age. You know, we're at year 10 or 11 of this upcycle, and there's a lot of good to talk about, even though the press covers a lot of bad, and we'll get into that. Another theme of this presentation is really about the United States. The United States is the economic high ground, and I'll show that to you with a couple statistics about what's going on in other countries in terms of the stock market and in terms of their own GDPs. Hopefully you can see this. This is a chart of GDP in the United States. And interestingly enough, there is cause for concern. You see that last column, if you can't read it, that last, in the column chart, the last column says that the GDP in Q2 was 2%. So quite a bit of a drop from Q1, which was 3.1%. In all of 2018 was 2.9%. So cause for concern. The economy definitely seems to be slowing down. What's fueled all the optimism over the years, though, is I think an interesting point that seemed to go away towards the end of last year, and that's that we had a lot of stability in these columns. You see how these columns even out versus what happened earlier. This created a lot of uncertainty. When this stability showed itself, we saw the stock market take off. We saw a lot of good things happen, and I think business confidence went up as well. If you looked at the surveys, that would conclude that. First point on the U.S., though, at 2%, which doesn't sound great, and it certainly isn't going to solve some of our major problems like the debt that sits on the national balance sheet. It is the economic high ground. If you take a look at the UK and Germany, for instance, in the last quarter, they were negative GDP. So if you're a capital provider and you're looking to attach yourself with some underlying economic drivers that will help you grow your business, you probably would think twice about investing in Germany or UK. And of course, UK's got the Brexit issue that seems to live on forever. But that is, those are only a couple examples. Japan grew, I think, at 0.3%. Japan has had a real hard time kickstarting their economy. Canada, our number one trading partner, was a shining star at 0.9%. Mexico, our third largest trading partner, was 0.3%. So, you know, if you think about Australia, I think was at 0.5%. I could go on. China has slowed as well. And so what I see in my business, and perhaps you might see in yours, is I see capital concentrating on the United States. Given the fact that we have 1,500 offices in 150 countries, we're constantly being called by our corporate finance colleagues and saying, hey, we're looking for X, Y, and Z. We're looking for it in the United States. Can you point us in the right direction? It's a very common theme these days in my business. Just going to check the notes, make sure I didn't miss anything. Oh, important point. So where do we go from here? This is all let me go back here. This is all historical information. That's all well and fine, but where do we go from here? I can only point to economists who study this information every day, and what you see is that economists generally think like this crowd. In the next year, we're not going to see a recession, which is defined as 2 quarters of negative GDP growth. The panel of Wall Street Journal economists, which is some 60 economists that the journal surveys routinely, say that we're looking at probably a growth rate slightly under 2% in the rest of 2019 and into 2020. So not great news, but certainly not anything compared to what's going on in other countries. Probably one of the more difficult spots in our economy is manufacturing, and you know you can surmise part of the reason has to do with the trade issues and the tariff struggles that we have. And one of the things that one of the data points that economists look to to understand the health or the relative health of the manufacturing sector is this ISM Purchasing Managers Index. And the Purchasing Managers Index is a survey of purchasing managers, and cutting to the chase, if they produce a monthly reading above 50, that says that the economy, the manufacturing world is expanding. If it's below 50, we're in contraction. And we went into contraction mode, I think it was it was a few readings ago. So we dipped below 50 and we're now at 47.8. I guess it was 50.4 in September. So, and it's been declining for 6 straight months. Manufacturing has definitely been hampered by a couple of things. Manufacturing has been hampered by the trade issues, but they've also been hampered by access to people. There is such a huge talent shortage in manufacturing that the manufacturing companies, if they could grow, they can't because they don't have the people to do the work. But the tariff impact is really impacting manufacturing to the point where it's becoming now broad-based. This ISM survey tracks 18 sectors or subsectors within manufacturing, and 15 of those sectors are now in decline versus 3 that they're showing some promise. Interestingly, though, if you pull away from manufacturing for a second, which is, I suspect, where most of us work here in this room, ISM also does a non-manufacturing survey, and that has been achieving great success. I think it's 106 consecutive months of positive expansion readings, and it continues in October at about 53 points. So another point I would like to make to the group is that we have some people, myself included, have a tendency to let certain data points overly influence us. Sure, there's problems in manufacturing. Sure, you can point to a couple of discrete things that are really causing that. I would also add in the GM strike, which is now settled. That was weighing on managers' minds, but it's really the tariffs, it's the GM strike, and it's the labor shortages that are hurting this piece of the marketplace, but not every piece of the marketplace. Some more bad news. People made a lot about the inverted yield curve back in August. The yield curve has historically been a remarkably accurate predictor of recessions. Interestingly enough, though, when the yield curve went negative, and the yield curve is inverted when the 10-year bond is trading at a lower rate than the 2-year Treasury. So subtract the 10-year bond rate from the 2-year Treasury, and if it's negative, it means people are harder to entice to invest in short-term securities, meaning they are assigning a higher level of risk to those short-term securities and what's going on in the marketplace. So you have to entice them, the rates go up, and the yield curve becomes inverted. Since 1955, this has been an accurate predictor of recessions. Interestingly enough, though, it takes 22 months for the recession to come after an inverted yield curve. I found that fascinating. If you think about it, anything could happen in those 22 months after the yield curve inverted that may have caused the recession. That people say on average 22 months after the curve inverts is when you can expect a recession. So that's sometime in 2021. I think it's July of 2021. There will be a clue, though, because a recession is formally declared when there's 2 quarters of negative growth. So 6 months prior to July of 2021, this curve would say that we're in a recession. Now, the smart people on TV would tell you, though, that it's different this time because of the tariffs. The tariffs are having an undue influence on this. So we'll all find out together, I suppose. Despite all this negative news, the consumer is sitting pretty, and I don't say that lightly. It's such a contrast to everything else you hear. And it's in part due to unemployment. Unemployment is at 3.5%. It hasn't been there since 1969, so 50 years. Can you see? It hasn't been there in 50 years. And that's remarkable. To put that in perspective, if you were to look at the average unemployment rate over the last 70 years, it was 5.7%. So we're quite a bit below the average. And so cause for consumers, most of us work. I think there's 160 million people in the country working right now. They're feeling pretty good. Wages are actually going up. That was a problem in the early part of the recovery, and actually until recently, wages weren't going up. But in the last 12 months, wages have gone up 3.2%. Doesn't sound like a lot of money, but it is positive momentum. And it is actually influencing consumer confidence. So consumer confidence is oftentimes measured by the University of Michigan. That's kind of the gold standard in all of this. And there's a lot of jewels in the most recent reading of consumer confidence. It stands at 96. That's not a percent, that's not a dollar, it's just a 96 is a reading. The long-term average on consumer confidence is in the mid-80s, so we're substantially above that. However, this sprung back from 89, which where it's spent for most of the end of the summer and the early fall. So consumers are a little concerned. The survey does show that consumers are every bit as knowledgeable as professionals who pay attention to the economy, in that they're citing issues with the economy. They're citing the tariffs, they're citing the impeachment, they're citing the GM strike as issues that cause them concern. But the positive momentum in their earnings and the low inflation environment are causing optimism, generally speaking, in the consumer world these days. And they believe that there's enough momentum for us as an economy to sustain itself despite the headwinds. Interestingly enough, I mentioned the impeachment. You'll find, I found it funny, you might not find it funny at all. The impeachment only registered 5% of all the participants, only 5% mentioned the impeachment as a concern of theirs. The GM, actually no, let me take that back. It was only 3%. The GM strike was 5%. The tariffs were 29%. So this is kind of how our fellow citizens are ranking cause for concern, but rises in income and income visibility are trumping all of it. So what does this all mean? I believe this is my last slide on the economy, and what it means to me is there's more here than meets the eye. We can sit here and complain about some of the headline problems, but the consumer is, what, 2/3 of our economy? Manufacturing, the negative stuff on slide 2, manufacturing represents 10% of our economy. It employs 11% of our workers. So it's important, but it's not going, you okay? It's not going to, it's not driving the bus. The consumer is driving the bus, and the consumer is positive. Any questions? Okay, let's move on to capital formation. Capital formation, without capital, we can't do much. I certainly couldn't do what I do, which is primarily sell companies. If there's no money to be had, then there's no purchase price, there's no nothing. Capital formation is really driving the M&A market right now. And this is probably the least of it. Certainly in certain spheres, people use their equity as currency to buy businesses, and this speaks to what's been going on in the stock market. It was a great time to be an investor in the United States in 2017. You can see here, if you can read it, that the NASDAQ was up 27%. The Dow was up 24%. The S&P was up over 18%. And it wasn't so bad in 2016 either. Everything was riding high here in the United States. If you look at some of the foreign indices, like the FTSE and the Nikkei and the Euro 600, they didn't experience that. We did, and we saw an influx of capital coming in the United States despite the relative expense of the US dollar. Things changed though in 18, and in part because, it was really volatility driven. Towards the end of 18, there was tremendous volatility, you may recall, in the market, and the market dropped by like 15% and erased all of the gains earlier in the year. And we actually ended negative somewhere between 5 and 6% on these indices for the year. So not a great year. It would have been a great year if you'd stayed invested till September and then you sold out. All the while, though, these stocks have been creating value, generally speaking, since the end of the recession. And you see here that the bulls have returned in 2019. The NASDAQ is up an even 20% this year. The Dow 15 and the S&P almost 18.5. That might make you feel good, but for the fact that for the last 6 months, none of these indices have moved at all. They're up 1%, 2% maybe. Things have flattened. And what's causing that? Well, I would tell you it's the tariffs. I would tell you it is fatigue. There's this very real thing we put in here, duration fatigue. People just expect a recession because we've been at this for 10 plus years. And as I said at the beginning, economists would tell you that up cycles don't die of old age. Something happens. And, it could be the tariffs. It could be a war. It could be, a bubble of some sort. There's a bubble in student loans, for instance. There was a bubble back in the day in the tech sector. Those things could do it. But generally speaking, this has been a great, the market caps of these stocks have been going up, and the stocks have looked generally attractive until recently. Oh, let's go forward. Part of the positiveness has to do with the earnings of those companies. This chart looks at median earnings per share in the S&P 500, and it shows that in recent quarters, things have started to level off. Whereas in Q2, we still had some positivity. We had companies blowing through their earnings estimates. We had companies blowing through their revenue estimates. Q3 is probably not going to be the case. Revenue for the S&P 500 is going to be up under 3% year over year from Q3 this year versus Q3 last year. And earnings is actually going to go negative, is what the smart people at FactSet are predicting. Interestingly, though, so if earnings is going down and revenue is going up, there's margin compression. And that speaks to the higher cost to do business these days. The higher costs related to employees, the higher costs related to importing because of the tariffs. And it's really putting a drain on earnings per share. That being said, if you look at the gray columns, that's the prediction for the future, according to FactSet. I honestly cannot tell you exactly where they get that data, but growth in earnings per share is expected to resume growing in the fourth quarter and then continue on. You'll see it dips in Q1, but relative to earlier Q1s, it's up dramatically. So earnings has been a source of capital for M&A, which is really the theme of my presentation, even though I haven't talked about it yet. We see our clients, and we see, if you look at the public company balance sheets, the level of cash that's sitting on them is astronomical. There's something like $2.5 trillion worth of cash sitting on public company non-bank balance sheets right now. And that trickles down to private companies as well. We see it in our business. I was working with a company in San Diego recently that had revenue of about $60 million and had $75 million parked offshore. They didn't know what to do with it. And, that's an extreme example, and it's probably pretty rare, but it's not uncommon to see the average $20 million in revenue company having $7 or $8 million in cash sitting on the balance sheet. Along with that cash is the private equity cash, which you folks probably talk about or hear about quite a bit. And this chart is an old attempt. Actually, this chart's probably 9, 10 months old now. I apologize, I couldn't find the new one. This chart says that there's $800 billion worth of raised but uninvested private equity capital right now. It's actually old news. It's actually closer to $1 trillion worth of private equity capital out there. And so if you're getting your door knocked on by the private equity world, it's because it's game on. The money's raised. It needs to be invested, and they've got 3 to 4 years to do that. So there's a tremendous amount of pressure to do that. And there's a lot of competition. The interesting thing about this $1 trillion is half of it is the mega funds. And I'm guessing that most of the people in this room are not hearing from the mega fund investors because they focus on the bigger companies. And they do the deals that you read about in the paper, not the great middle market companies that are transacting. Mega funds, though, are dipping down because they're buying businesses and those businesses are buying add-ons. They're actually dipping down for another reason. They're dipping down to smaller deals because there's not enough bigger deals to be had. If you look at the distribution of deals by size, 66% of all deals are below 100 million. If you add in the tranche between 250 and 100 million, so anything under 250 million is about 85% of the market, M&A marketplace. So if you are a mega fund, or if you're KKR or name pick your favorite, they're fighting for 15% of actual market deal flow, and it's not enough. You know, when you go out and you raise a $5 billion fund or a $10 billion fund, it's hard to put the money to work. So we're seeing them dip down into the middle market in instances and creating a lot of competition for smaller private equity firms, and the valuations have gone up because of that. Banks have been accommodative. I don't know if any of the Wells Fargo guys are in the room, but I'd love to hear if they have anything to say on this. But you know, clearly the lending community, along with that strategic equity and the private equity, banks are kind of the third leg on the stool in terms of capital formation going at a deal. And what you see is that, and these are lower middle market, this data pertains to middle market deals, 250 million and below. And what you see is on average, they're lending 4 times EBITDA in those situations, in M&A situations. It's been a relatively steady 4 times since 2015. About a turn of that, or one times, has been sub debt on average, and 3 times has been senior debt. And so a private equity firm does know that they can go to a bank on average and get 4 turns. Some are doing 6, some are doing 2. In fact, I think that these numbers should be coming down because we've noticed as the upcycle has continued that PE firms have shown a greater caution in their borrowing because they don't want to be caught tripping covenants in a recession. And what you're seeing, though, is the private equity folks are still bidding up deals, and they're just adding more equity. So this bar, if you can't read it, says that at present, 47.9% of the cap structure in an M&A transaction is in the form of equity by the buyer. 11.1% is sub debt, and 41% is senior debt, is on average how the money is coming together to get these deals done. Yeah, I have to laugh, though, when I think about a deal we recently did. We sold this company in California, and we had 29 offers. And 12 of them were ones that we wanted to nurture to conclusion. And the strategic buyers came to us and said, tell us who's looking at it. Of course, we never tell them that. But they wanted to specifically know if private equity was interested in the deal. Odd as it sounds, strategic buyers are becoming more and more concerned with the private equity world and their competitiveness from a price standpoint. And I think this chart doesn't do it justice, but how they're doing that is private equity people are placing bigger bets and putting down more equity capital into these deals. And in the meantime, investing a lot in thesis, their investment thesis, and bringing in consultants and operating partners and whatnot to get comfortable that they're placing a good bet, albeit a bigger bet than they have traditionally done that. And they're actually spooking the strategic buyer universe in the process. One other area where capital has been around to fund transactions and grow businesses has been IPO issuance. I personally don't spend a whole lot of time in IPOs, but I can just tell you that the volatility has really been a detriment to IPO issuances in the most recent quarter. It was it wasn't a big deal in Q1. The Q1 problem was we had a government shutdown, and for some reason, those that are involved in IPOs weren't busy because of that. But you can expect volatility in this when you have volatility in the stock market, because the underwriters can't predict how the stock's going to do when the market's so choppy, and it's relatively flat right now. That being said, if you look at the IPO pipeline, it's growing. So, one company I follow in this regard is Renaissance Capital, and they're basically saying to expect Q4 to be an active time for actual IPO launches. And with good reason. If you look at the IPO index of Renaissance Capital, those stocks have performed well relative to the rest of the market. So clearly a viable way to raise capital is the IPO market, even though Q3 was not a fun time for those involved. So moving on to the actual M&A activity. Where have we been and where are we going? This chart speaks to deal count in the middle market, which is $500 million deals and below. And the bar chart is the number of transactions, and the blue column is the aggregate value. And what you see, the first thing I notice when I look at this is that 2014 and 2015 must have been one heck of a time to be involved in this, because not only was aggregate value higher, but and it stands to reason, more transactions got done. So what's happened since then? Well, I would submit to you that that little period of time was very unusual in that you had more companies going to market that were afraid to go to market prior to that. If you remember the recession, in the recession we had virtually no M&A. What are the first companies to go to market coming out of the recession? Well, they were, in this case, the better companies. The better companies came into the marketplace first thinking, I'm going to be brave, I want to sell my company. We just went through this awful time, but hey, I did well, it's time for me to sell. They had the courage to go to market. And as the years went on, it kind of crescendoed in 2014 with more average companies coming to market. So, because the market was accepting of this. I was saying at the time, it's not a question of if you can sell your business, it was a question of what the price would be. And we definitely saw a lot of activity. And what you're seeing in the downslope is more of a normalizing of the marketplace. Actually, the trend line should be really through here, cutting off the tops of these 2 years. So the market is still really healthy and very active, and I think that some of the drawback in it is some of the negative stuff that we talked about earlier in the presentation, as well as the fact that people are getting antsy for the recession to come, and they're rushing to market. And so we're actually seeing an actual increase in the first half deal activity in the middle market in the United States right now. And it's being fueled by that capital. All that capital that's out there is wanting to find a home before the wheels come off the bus. And one of the themes that I'd like to convey is that the wheels aren't going to come off the bus, and interestingly enough, buyers aren't afraid of it. We at BDO do this survey, and it's a private equity survey, and we've done it for 10 years in a row, and we survey PE executives and ask them all kinds of what I think are interesting questions. One of the questions we really drilled down on the last survey was, what are you going to do to fight the recession? What are the levers that you can pull to protect yourself? And, there were answers like, hey, do better due diligence, be real disciplined in your valuation, make sure there's a strategic fit, things like that. But what was really surprising is how casually they talked about hold period. If a recession comes when you were planning on selling, hold on to it a little longer. These funds do have finite lives, but they believe there's generally some wiggle room in the exit such that they're not overly concerned about that. In fact, they're holding on to businesses longer right now because they're paying so much that it takes time to affect change in the business to earn an acceptable return. You pay 9 times for the average business, which I'll show you in a minute, is about the average EBITDA multiple right now for a generic good business in the United States. You have to make a lot of change to that business in order for the discounted cash flow to pencil out. You have to make a lot of growth in earnings and assume that there's going to be an acceptable exit multiple at the end, and that takes time. This chart is, I already kind of stole my own thunder. You probably can't see this, but it basically says that 66% of deals are under 100 million. Add in the 20% that are between 100 and 250, and you're at 86% of deal flow is below 250, which is great for us deal people because most of us are in the middle market where we can enjoy being busy. Yeah, please.
Why is there such a rush to place this capital if people feel like a recession is coming, as opposed to maintaining a cash position and being able to buy these businesses for less a few years down the road?
Yeah. Well, there's a couple things to that. That makes perfect sense, and I think that is a theme. I probably didn't emphasize it the way I should have, but the private equity people the clock's ticking on them. They usually have 10-year funds. So they invest into boom markets, they invest into down markets, and they just calibrate their diligence and their discipline. And as I said, and I've noticed in my 25 years of doing this, they've become smarter at learning about sectors where they're going to focus. Many of them are industry focused, many of them study industries, many of them come up with white paper analyses of what they think they should be doing, and then go out and find those businesses. Strategics can be more cautious, but the public companies have to continue to grow. There's the quarterly earnings pressure. And then last but not least, it's not like going out and buying your next loaf of bread. When something comes on the market, it needs to be pursued because it might be the perfect fit for a large strategic, and they can't wait. It's here now. And you would expect more to be on the market just prior to the recession than in the middle of the recession. People are trying to get out before things get bad. I'll tell you, the backdrop to this is also very interesting because we have baby boomers that own 50+% of the middle market companies in this country still. And the youngest baby boomer is 55 years old. Some of the younger people in this room probably don't even want to be working at 55. So you can imagine what a baby boomer's thinking. I'm 55, I'm going to sell my business. The oldest baby boomers are 72 now. So there is this wave of liquidity that they're pursuing that defies all of this. And it's going to keep people busy for a while. And whether you're selling in the middle, there'll be probably more activity during the next recession because of this. It's certainly more active now because of that as well. So one of the tools private equities firms are using to become more competitive is they're doing more add-ons. This I've never, if I could have drawn this chart just wanting it to make a point, I couldn't have drawn it any better than the actual data. This line shows that back in 2006, 46% of deals done by private equity were add-ons. So they bought a platform and they sought to grow it in part by buying other businesses that were complementary, 46% of the time. Now it's 71%, the first half of 2019. Nearly, well, it's not double, but it's a lot more. And it's a lot more because when you own a platform and you do an add-on, you're now a strategic. And you now benefit from certain synergies, and you now benefit from value creation opportunities to the point where you're willing to pay more. And so we've seen this, and this is one of the ways that private equity is becoming more and more competitive. And where it goes from here, I don't know. It seems unsustainable given the deal flow that I see, that it can go any higher. It probably should go lower, but it's definitely become more of a strategy. Years ago, private equity firms would say to me, we don't do add-ons. We don't do roll-ups. We're going to focus on fixing the business or improving the business we bought. But now pretty much everybody sees that as a viable strategy to grow their platforms. And so they look for industries that are fragmented. And so there's lots of little players to gobble up. This chart simply speaks to hold period. The hold period from the time a private equity firm buys a business until they exit it, on average, is about 4.6 years now. It's coming down, but it was clearly much lower pre-recession. Pre-recession, people were buying these businesses and getting rid of them, in 18 months sometimes. It was remarkable. We're going to get in. We saw an opportunity to buy low, made a few improvements. We're getting out. Nowadays, they have to, as I just said a few minutes ago, they have to do a lot to those businesses in order to make them better and more valuable. And so hold periods are probably going to stay at this level, if not go up. And in fact, I think they did go up. This data is a little old. Multiples. The average EBITDA multiple for a middle market company is 8.8 times right now. To me, that seems really high, and it's frankly probably unsustainable. Interestingly, remember how I talked about all the activity back in the 14, 15 timeframe? That's when post-recession the multiples were highest. There was just a lot more activity and a lot more competition for businesses. There's still that, but I think that they're injecting more discipline into the valuation decision right now, and that's causing multiples to come down, albeit from, 8.8 is, if you do the math like I do, and I'm selling a business, and I give a buyer some projections, and I say, what's this worth to you? And they say 8.8 times, you're like, well, your projections are more rosy than mine. So you're expecting to do a lot with this business. You're going to hold it longer, and you're going to make dramatic change. And that's what we're seeing. And these are averages. So many businesses trade a lot lower, many businesses trade a lot higher, and I'll give you one quick example. I was fortunate enough earlier this year to sell two companies at the same time that had basically the same profile. One was here in the West, and one was in Scotland. And there were differences with the businesses, but you wouldn't know it outside looking in. One was about twice the size, but they both had kind of critical mass. Both had been around about 20 years. We ended up selling these two businesses to the same buyer. The buyer paid 16 times for one of the businesses, so much higher than that average. And they paid 6 times for the other one. The devil's in the detail, and you have to look at things like customer concentration, proprietary know-how, patents, trends in the data, markets served, customer concentration. So as you think about the value of your business, and we're obviously happy to talk with you about the levers of valuation, but I just say this more to caution people. I just went to a conference and I heard this guy say, I'm going to sell my business for 8.8 times. That's just not being thoughtful enough, and I'm sure you're more thoughtful than that. But word to the wise, it's a little bit more complicated. So this is second to last slide. This looks at multiples by sector. And surprise, surprise, IT and healthcare seem to be the more lucrative sectors. And if you think about IT, there's many game-changing technologies, and there's lots of available market, and there's high growth potential. In fact, I think that multiple doesn't do it justice. Similar things are going on in the healthcare space. I'm sure there's others in this room who know that better than me, but that explains that. When you start to see consumer discretionary multiples lower than consumer staples, staples meaning you need them in a recession, discretionary items you can forego, they're discretionary. That's a leading indicator of a recession. But I wouldn't put too much stock in that because these are still high multiples. And then last, I'll end on the multiples discussion unless people have questions, just to say that some good basic industries really lead the pie here. So industrials, I think, is 19% of the M&A landscape right now. Consumers, 18%. IT is 16%. So that's where all the action is, according to that pie chart. Any questions? I have to say, I didn't expect to fill my time. This thing tells me I've got a minute and a half left. Thank you for listening. Again, what I wanted to convey is that the economy is relatively strong. Tariffs are kind of throwing up a lot of dust and confusing things. And, that can snowball, and that can cause problems with hiring and people worrying about how to make payroll and whatnot. And that's really, when you think about the economy, it's a makeup of a lot of billions and billions of decisions about staffing and who to pursue as a customer and whatnot. And, and then you overlay optimism or lack thereof on that. And that's the stuff that drives markets like this. And I think we're in a relatively good place. If you asked me when I thought a recession was coming, I would have said clearly not this year, maybe not even the next year. I don't see why it would happen short of a, exogenous factor. So, you had a question, sir?
You talked about earlier about capital concentrating in the U.S.
Mm-hmm.
I just wonder, do you see that as good or bad?
I see it as good. Investment is good. I guess the only way it would be bad is if, the people who own those assets that they're buying are bad people. Boy, I'm not as deep as I thought. I like it because it makes my business more fun and interesting and more active. And if I was the owner of a business, and I was thinking of selling it, and I hired somebody to go out and make a smart market about it, I would want the more the merrier to be interested in my business, for sure.
About, for example, the Chinese investing.
That spigot is shut off. I'm clearly worried about that. I had a client once that built these machines. And they decided after 30 years of being in business to take it to China, only to find out a quarter after they did that there was a knockoff of their machine in the marketplace, competing at the Chinese trade show for that particular product. That's bad. It's real bad. But that's just one, albeit large, slice. Money coming in from Europe, coming in from other parts of Asia, coming in from, I sold a business last year to a public company in Australia. It's been such a good thing for the company. It was a $40 million company when we sold it. I think they're doing about $90 million now. And that company came in, bought it, and just funded explosive growth. So generally speaking, it's a good thing. And in most businesses, no matter even the smallest businesses in our economy, are doing business globally. Something like 30% of the revenue in the S&P 500 is international sales. So, if they want to come and do business with us, I think it's probably a good thing. Any other questions? I made it all up. Thank you very much.